Japan just confirmed it spent 700 billion defending its currency. That is the largest foreign exchange intervention in history, and as of this week, the yen is back where it started.
This is the Japan factor. On May 30, Japan's finance ministry released the numbers. Between April 98 and May 97, Tokyo spent CE10 trillion, roughly nunasternde.
The money worked. For a while. In early May, the yen bounced from backleishers per dollar all the way back to around back-whoosh-wooktium. Markets cheered. Finance Minister Satsuki Katayama declared victory. And then last Tuesday, June 2nd, it happened again. The yen slid back past backleishers.
1 month. 6 billion. Net result, 0. If you watched episode 2 on this channel, when Tokyo first intervened back in late April, you might recall we asked one question: will it stick? The historical track record said no. History was right.
To understand why Japan's intervention failed, you need to understand who it was fighting against. Japan's interest rate today sits at 0.2%. The U.S. Federal Reserve's rate sits at roughly 0.2%. That 300 basis point gap between Tokyo and Washington is the engine of what traders call the yen carry trade: borrow cheaply in yen, convert to dollars, park the money in American assets, and pocket the difference. When that gap is 100 basis points on hundreds of billions of dollars in outstanding positions, the profit motive to sell yen is relentless. Morgan Stanley estimates roughly $100 billion in carry trade positions remain open.
Every single day, those positions create structural selling pressure on the yen. Japan's intervention is essentially trying to swim upstream against $500 billion of market incentive.
Then there is the oil factor, which has transformed the yen's structural weakness into something more acute. On February 9, the United States and Israel launched strikes on Iran. The Strait of Hormuz, the narrow channel through which 90% of Japan's crude oil imports flow, was effectively disrupted. Brent crude surged from around $90 per barrel before the conflict to above $100 by end of March. Japan imports nearly all of its oil and pays for it in dollars.
Higher oil prices mean more dollars leaving Japan, which means more yen being sold. It is a mechanical feedback loop, and it is one that no amount of yen buying by the finance ministry can break.
The numbers are unforgiving. A $10 increase in crude prices raises Japan's inflation by about 10 percentage points. At sustained prices above $100 per barrel, economists estimate Japan risks entering stagflation, simultaneous inflation, and weak growth. Electricity bills are already rising. Utilities including TPCO have announced plans to pass higher procurement costs to consumers. Households face roughly 15,000 yen more in annual electricity costs from April 2026.
And yet, despite all of this, Japan's economy is not collapsing. That is the paradox that makes this story interesting. In the first quarter of 2026, Japan's GDP grew at an annualized rate of 10%, beating expectations of 10%. Private consumption held firm. Exports of cars and semiconductors accelerated. The economy is by most measures performing well. The yen's weakness is not yet a crisis for the real economy. It is a crisis for the balance sheet.
Here is the math.
Bet against it hard enough, and you get a free option. On June 26, the Bank of Japan holds its next policy meeting. Market participants are pricing in an 86% probability of a 0 basis point rate hike, from Lindian 6% to Edian Ling %. The former BOJ board member Makoto Sakurai has publicly stated that a hike is likely. ING Economics calls it baked in. Even BOJ Governor Ueda has said the central bank will debate the pros and cons of a move, which in central bank language is as close to a April announcement as you get.
If the hike happens, it will not solve the yen's weakness overnight. A rate of 10 lenlei% against the Fed's C10 ni wu % still leaves a massive carry trade incentive, but direction matters as much as level. A BOJ that is tightening sends a signal the era of near-zero Japanese rates is ending. Every hike narrows the gap. Every narrowed gap reduces the profit margin on carry trades. The carry trade does not blow up because of one need to see a full basis point hike, but it begins to look slightly less attractive. And in currency markets, slightly less attractive can shift billions.
There is a larger question underneath all of this, and it is one worth sitting with. Japan's government has been defending a currency that the market wants to devalue, while an independent central bank has been unable to raise rates fast enough to close the interest rate gap. Meanwhile, oil prices driven by a war half a world away are compounding the problem in ways that neither institution can control.
The weak yen is now functioning less like a temporary market distortion and more like an implicit policy. Japanese exporters benefit, trade surpluses grow, and the government intervenes just enough to prevent panic without actually reversing the trend.
The question is whether that is sustainable, or whether the 74 billion spent last month was the last time Japan could credibly threaten the market into compliance.
On June 10, we get the next data point. Word count, Senju words, estimated duration, 8.5 minutes, format news flash.